Hello everyone. Today I would like to talk about one topic which has been haunting a lot of investors after the Sensex touched 80,000. So I, Patik the Traveler, welcome you to my YouTube channel. Today we will try to explore whether the current markets are actually overvalued. So let's start. What is the meaning of the valuations of the markets? If I paraphrase my question, then when can we say that a market or the Indian share market is overvalued? One simple way to do this calculation is to compare the current valuations of Nifty 50 with its historical average. Right now, if we look at the statistics that we will just explore, major indices like Nifty 50 or mid cap or small caps are at all time high levels. But their valuations in terms of PE and PB are at their 5-year average. The data in front of you once again proves the same fact. For example, if you look at the Nifty Small Cap 100 index, then current valuation in terms of PE, price to earning ratio, is 30.23, while its 5-year average PE is around 32. If you look at Nifty Midcap 100 index, its current PE is around 43, while its 5-year average PE is around 44. If we look at Nifty 50, which is very important for many people, then what we can see is that its current PE is around 24 and its 5-year average of PE is around 25.5. So we can definitely conclude one thing, that right now markets are definitely not cheap, but there is unnecessary brouhaha or there is unnecessary discussion in the market that markets are overvalued, that valuations are overstretched, or that the market is going to fall because there is too much heat in the market or the valuations are very high. Now, the fact is that this current growth is also being reasonably supported by the increase in the earnings, and that's why the valuations even look more attractive. Valuations are not too bloated due to the heavy growth in the corporate earnings. It would be unfair to say that market is overvalued simply because Sensex has touched 80,000 mark. In fact, many top companies are expected to report good numbers, that is, good earning numbers in the first quarter of 2024-25, which would make or take the PE figures further down. In one study, the Sensex P is at every 5,000 points since the level of 50,000 were considered and compared with the current PE levels. In case of banking and finance stocks, where generally PE is not used to calculate the valuations, price to book multiples were taken into account. And according to the study, the current trailing Sensex PE is of rupees 24.3, is among the lowest compared to the PE levels when the index was at 50,000, 55,000, 60,000, 70,000, and 75,000. For example, at 65,000, the Sensex PE was a tad lower at 24.2 compared to the current 24.3. The highest PE was of 34.4 when the Sensex touched 50,000 in January 2021. It came down to 31.3 by the time Sensex crossed 60,000 in September 2021, reflecting a pickup in the corporate earnings. In terms of valuations of individual constituents of the Sensex, out of 30, 17 companies currently trade above their 3-year and 5-year average valuations. That means almost half of the Sensex 30 companies are actually not overvalued, and the rest are also, although they are actually trading above the average of their 5 years, but still Combinedly, the Sensex 30 doesn't look overstretched by any stretch of imagination or data. So the conclusion is, according to me, that markets are definitely not undervalued, but they are a little bit stretched in terms of valuations, is what I would like to conclude. If you look at the numbers further, then the same fact has been highlighted here as well. If you look at the journey of Sensex from 50,000 to 55 to 60 to 65, you will realize that overall the PE values in fact have gone down. The reason is that all this growth in Sensex has been supported by the earnings in general. Then, in other words, the earnings have increased. So, if you look at the PE numbers and the corresponding numbers of the Sensex or the level of Sensex, the data tells us that there is nothing like the markets are overvalued or overstretched or something like that is there. Yes, if you look at certain constituents of the Sensex 30, then Reliance, HDFC Bank, ICICI Bank, SBI. Okay, these are some of the companies which are basically trading higher compared to their 5-year or 3-year averages. But here also the numbers are not too high except in some companies. So what is the implication of all this analysis on your investment? As an investor, one must not be interested too much into this type of academic exercise. So let us look at the implications of the same for your investment. Of course, I do not have the rights to speak on individual shares, but definitely the SEBI norms allow me to speak about the sectors in general or give general commentary on the market. So, according to me, if you want to explore the sectors in which you can put your money or invest fresh money, here are some sectors that you can definitely explore, or the companies from these sectors. Some of them may be available at cheap valuation. Please keep in mind that it is not possible that in every sector or in any sector all the companies would be trading at cheap valuations. In every sector, some companies would be trading at cheap valuations while some may be trading at higher valuations. So one has to do a very stock specific research. But despite that, in general, the following sectors are worth considering in terms of attractive valuations: agrochemicals, food processing, pharmaceuticals, information technology, private banks, cement, manufacturing, and infrastructure. Try and buy companies with clean business models, fairly reasonable valuations, and there are lots of companies which are displaying turnaround stories with strong fundamentals. There are many companies whose business models are getting established. There are many startups who have been listed for some time and now their business models are well established and the earnings are growing. One can definitely look at such fundamentally strong companies or companies with a very good business model. Of course, the biggest opportunity is in small caps, so is the risk. If you are a mutual fund investor, you must continue to stay focused on the goals and asset allocation and avoid the near term noise. If you are a stock investor, sorry, there is a typo here. If you are a direct stock investor or equity investor, it would be a good idea to leave the sectors, book profits, or at least take the capital out of the sectors which are overvalued. For example, defense shares in general look overvalued. Many PSUs, their valuations look stretched. But one more thing is that if one is planning to enter the defense sector or if one is looking to buy more PSUs, one should really do a very clear stock specific analysis. And once again, investment is all about stock picking, and all this analysis may lead to paralysis if taken over seriously. So I hope that my commentary has at least given you some idea about the value or current value of the market. Thank you very much and good night.